The stock market is where investors connect to buy and sell investments, most commonly stocks, which are shares of ownership in a public company. If the thought of investing in the stock market scares you, you're not alone. Individuals with very limited experience in stock investing are mostly terrified. But don't worry, because today we are going to tell you how the stock market works. Number 8. How does the stock market work? The concept behind how the stock market works is pretty simple, operating much like an auction house. The stock market enables buyers and sellers to negotiate prices and make trades. The stock market works through a network of exchanges. You may have heard of the New York Stock Exchange or the NASDAQ. Companies list shares of their stock on the exchange through a process called an initial public offering, or IPO. Investors purchase those shares, which allows the company to raise money to grow its business. Investors can then buy and sell these stocks among themselves, and the exchange tracks the supply and demand of each listed stock. That supply and demand help determine the price for each security, or the levels at which stock market participants, investors, and traders are willing to buy or sell. Buyers offer a bid, or the highest amount they're willing to pay, which is usually lower than the amount sellers ask for in exchange. This difference is called the bid-ask spread. For a trade to occur, a buyer needs to increase his price or a seller needs to decrease hers. This all may sound complicated, but computer algorithms generally do most of the price-setting calculations. When buying stock, you'll see the bid, ask, and bid-ask spread on your broker website. But in many cases, the difference will be pennies and won't be much of a concern for beginner and long-term investors. Number 7. How stocks work. When you purchase stock in a company, that means you're buying a slice of ownership in that business. Companies use stock to raise money for expansion, create products, and fund other business expenses. When a company first appears in the stock market, they'll offer shares to their company via an initial public offering, IPO. After the IPO, shares trade publicly on a daily basis. Buyers and sellers will exchange shares in the current market price. Most investors will purchase and sell their stocks through a broker. To purchase stocks online, you'll need to open a brokerage account. From there, you can submit, buy, and sell orders with the funds that you have available. The stock is a way for the average consumer to build wealth by purchasing small pieces of a company. For most stockholders, you are purchasing a portion of their profits. While you may be able to vote on issues or attend stockholder conference calls, purchasing stock in a company doesn't entitle you to traditional assets or decision-making power. There are 2 ways to make a return from stocks. The stock price could go up. Once the stock price goes up, you can sell the stock for a profit. For example, if you purchased 100 shares of stock at $100 each, your initial investment would be $10,000. If the stock price goes up to $120 per share, you could sell your stock for $12,000 for a profit of $2,000 in dividends. Some stocks offer dividends. Instead of using all the profit to grow the company, a portion of the profit are paid out to shareholders as dividends. Companies typically send these payments out quarterly. Not all stocks offer dividends. While lots of factors impact a stock price, it's mostly a reflection of the growth prospects of a given company. If investors expect plenty of growth, that'll be baked into the price. If they don't, the stock will be worth much less. And for the prices to change, the company needs to surpass or underdeliver on those expectations. Number 6. How share prices are set. The prices of shares on a stock market can be set in a number of ways, but the most common way is through an auction process where buyers and sellers place bids and offers to buy or sell. A bid is a price at which somebody wishes to buy, and an offer, or ask, is the price at which somebody wishes to sell. When the bid and ask coincide, a trade is made. The overall market is made up of millions of investors and traders who may have differing ideas about the value of a specific stock, and thus the price at which they are willing to buy or sell it. The thousands of transactions that occur as these investors and traders convert their intentions to actions by buying and/or selling a stock cause minute-by-minute gyrations in it over the course of a trading day. A stock exchange provides a platform where such trading can be easily conducted by matching buyers and sellers of stocks. For the average person to get access to these exchanges, they would need a stockbroker. This stockbroker acts as the middleman between the buyer and the seller. Getting a stockbroker is most commonly accomplished by creating an account with a well-established retail broker. Number 5. Stock market supply and demand. The stock market also offers a fascinating example of the laws of supply and demand at work in real time. For every stock transaction, there must be a buyer and a seller. Because of the immutable laws of supply and demand, if there are more buyers for a specific stock than there are sellers of it, the stock price will trend up. Conversely, if there are more sellers of the stock than buyers, the price will trend down. The bid-ask or bid-offer spread, the difference between the bid price of a stock and its ask or offer price, represents the difference between the highest price that the buyer is willing to pay or bid for a stock and the lowest price at which a seller is offering the stock. A trade transaction occurs either when a buyer accepts the ask price or a seller takes the bid price. If buyers outnumber sellers, they may be willing to raise their bids in order to acquire the stock. Sellers will, therefore, ask higher prices for it, ratcheting the price up. If sellers outnumber buyers, they may be willing to accept lower offers for the stock, while buyers will also lower their bids, effectively forcing the price down. Number 4. What is stock market volatility? Investing in the stock market does come with risks, but with the right investment strategies, it can be done safely with minimal risk of long-term losses. Day trading, which requires rapidly buying and selling stocks based on price swings, is extremely risky. Conversely, investing in a stock market for a long term has proven to be an excellent way to build wealth over time. For example, the S&P 500 has a historical average annualizing total return of about 10% before adjusting for inflation. However, rarely will the market provide that return on a year-to-year basis. Some years the stock market could end down significantly, others up tremendously. These large swings are due to market volatility, or periods when stock prices rise and fall unexpectedly. If you're actively buying and selling stocks, there's a good chance you'll get it wrong at some point, buying or selling at the wrong time, resulting in a loss. The key to investing safely is to stay invested through the ups and the downs in low-cost index funds that track the whole market so that your returns might mirror the historical average. Number 3. Bull markets versus bear markets. Neither is an animal you'd want to run into on a hike, but the market has picked the bear as the true symbol of fear. A bear market means stock prices are falling. Thresholds vary, but generally to the tune of 20% or more, across several of the indexes referenced earlier. Bull markets are followed by bear markets, and vice versa, with both often signaling the start of larger economic patterns. In other words, a bull market typically means investors are confident, which indicates economic growth. A bear market shows investors are pulling back, indicating the economy may do so as well. The good news is that the average bull market far outlasts the average bear market, which is why over the long term you can grow your money by investing in stocks. The S&P 500, which holds around 500 of the largest stocks in the United States, has historically returned an average of around 7% annually. When you factor in reinvested dividends and adjust for inflation. That means if you invested $1,000 30 years ago, you could have around $7,600 today. Explore this further with NerdWallet's investment calculator. Number 2. What makes stock prices go up and down? There are many factors that determine whether stock prices rise or fall. These include the media, the opinions of well-known investors, natural disasters, political and social unrest, risk, supply and demand, and the lack of or abundance of suitable alternatives. The compilation of these factors, plus all relevant information that has been disseminated, creates a certain type of sentiment, i.e., bullish or bearish, and a corresponding number of buyers and sellers. If there are more sellers than buyers, stock prices tend to fall. Conversely, when there are more buyers than sellers, stock prices tend to rise. Number 1. Why is the stock market so difficult to predict? Let's assume stock prices have been rising for several years. Investors realize that a correction will come and stock prices will tumble. What we don't understand is what will trigger the sell-off, or exactly when it will occur. Therefore, some investors will sit on the sidelines holding cash, waiting for the opportune time to get in. Those who are willing to assume the risk may jump in because the return on cash is so low and it hurts to earn zero while watching stocks move higher. This begs a couple of key questions. If you're on the sidelines, how will you know when to get in? If you're already in, how will you know when it's time to get out? If the stock market was predictable, these questions could easily be answered. However, it is not. There are actually 3 issues an investor should consider. The first is understanding the point at which stock prices are fairly valued. The second issue is the event that will cause a downturn. The final issue is understanding the human decision-making process. Do share with us in the comments if you know more about the stock market. Please subscribe to the Stock Advisor. Thanks for watching.